Okay, good evening, everyone. Thank you for coming over for this event. Actually, I was actually stationed in MBFC and I couldn't get a cab, so I have to walk here, which is luckily not so far. Anyway, the gist of my presentation cover three areas. Basically, what is the current market environment and what is the macro outlook. So I give you a more deeper insight of how SCB views the market. And next, I will also talk about the very, very important person. No, it's not that, but the very VVIP strategy in making investment decisions and in constructing your portfolio. And last but not least, I will also talk about what are the investment opportunities within the VVIP framework. Okay, if someone were to take a vacation at the start of the year and come back, say, last week, and then he will be surprised that actually the markets actually rebounded compared to last year. So if you look at the markets as of last week, other than China, which as you know has been slowing down, the rest of the markets are doing very well. If you look at STI index, it was actually about 15% as of last week. And you compare this against last year, it was down minus 17%. If you look at the China right now, it's about minus 4.9%. And the best performer is actually the less open countries like Philippines. Thailand is actually up 20.7% versus like minus 0.7% last year. If you look at Europe, you think that things are so bad, but actually the only two markets that are actually underperforming is actually Italy and Spain. In fact, if you look at Germany, Germany is really up 18.2%. Doesn't look like things are a lot of problems in Europe, but actually markets are also very savvy. They just look at those economies that are not doing well. So look at Spain. Spain right now is minus 14.7%. But at one point in time, maybe in like June, they were down almost 30%. And if you look at, say, the America, actually America has been doing well for the last 2 years. And let's say you look at Dow Jones. Dow Jones for the last 2 years has been up. This year, up 7.7%. Last year was 5.5%. S&P 500 last year was flat. And this year already up 12.2%. No thanks to like stocks like Apple and all that did very, very well. And these are one of the main stocks in S&P and Nasdaq. And if you look at currencies-wise, it's mixed. The US dollar is mixed. If you look at US dollar versus yen versus euro versus the Indian rupees, they are up against that currencies. But if you look at against the other emerging countries like Singapore, Malaysia and also Australia, New Zealand, they are actually down. So US, if you look at the start of the year, it was about 1.29. Currently, it's about 1.25. And if you look at back the last few months, the last 8 months, it's more like a roller coaster ride. Right? If you see the first quarter, you know there's a LTRO, the 3 years, 1% loan that actually propelled the first quarter performance. Then after that, the second quarter, markets went down again because there's slowing growth, there's a Greece re-election problems, and then after that, there's of course the Spanish problems. Then after that, markets start to go up again because there's a Spain bailout, Greece finally formed a government. And also because of ECB, that the chief Draghi actually says that he will take whatever it takes to save the euro, and markets are really expecting a lot from the policymakers. And actually, that's why one of the main drivers, right, for markets is actually about expectations. So markets are always very forward-looking. So it doesn't mean that you have a lot of bad news, like wow, economy is going down, business going bad. It doesn't mean that markets will also go down. Markets, as long as the news are less bad, right, markets will still go up. And if you look at the last few months, the economic data, especially from US, has been actually doing much better than expected. You can hear that the new home sales are going up, housing prices in US is going up. I think people are also aware of all the Greece problems. Greece is like, the third year we talk about Greece problems and about the euro debt problem. So market is really getting used to that. And also China, market also getting used that China is slowing down. And also expecting China, when they have the leadership transition in October, and some sort of stimulus, then China will probably rally towards the end of the year. And what you notice, right, is that one of the big topic right now is actually the debt problems in US, Europe, as well as Japan. And no thanks to them bailing out, the banks, the car companies, the insurance companies. And right now, they are facing the problem of how to service their debt. And there are 4 medicines how to resolve, how to cut down your debt. And one way that Greece followed, which is to default, which you see in March, they actually have a 50% haircut to their loans, their bonds. And the consequences of default is that people don't trust you anymore. And that's why they actually are at the mercy of, say, the creditors like the IMF, to push them for reforms and restructuring. And of course, the people will definitely don't like it. And the next thing is that you can reduce your debt is by growing the economy. The trouble is that it takes time to grow the economy. And if you're growing 1% or -%, and your borrowing cost is 4%, your debt to GDP will always go up. And politicians doesn't have time, because if they don't do something about it, they will definitely lose the next elections. So then the third thing you might consider is that the country might consider is to save. That means to cut spending. But the problem with cutting spending is that you probably have a lower standard of living, and that's also not good for the economy. And of course, cut spending means less spending for the economy, then less growth for the economy. Then what the politicians do, which is the easy way out, is to print money, which is to have easy and cheap money. And this is why this is what propelled the economy, the markets the last few years. So if you look at the balance sheet for the Federal Reserve, the US Federal Reserve, the ECB, the European Central Bank, right, you notice that the balance sheet has ballooned up to more than 3 trillion. 3 trillion means 3,000 billion in US and Europe. If you look at the black line actually shows the US Fed balance sheet. Notice the first spike in late 2008, that is your so-called QE1, where they start to purchase government bonds during the first period. And you notice that the second half of 2010, when markets start to rally again, is also because of this QE2 that the Fed did, which is around September 2010. And then more recently, you have this LTRO, which means a cheap 1% 3-year loans that the ECB actually provided to the banks in December and February. And this was actually the catalyst for the first quarter strong performance you see in equity markets. But the trouble with LTRO, which is they call it a long-term, refinance operation, right, is that the banks use this money, right, which is the good thing, is to buy back the bonds. So let's say you get 3 years of 1% loan. And in order to get fast profit, right, what you do is that just buy the government bonds, which is very high at that time, at 6-7%, and you get to earn a spread of 5 to 6%. And this is what the banks do. And this helped the bond yields, the borrowing costs for Spain, Italy to come down a lot, which you see the first 3 months of the year. But after, when you use up the money, right, and then more or less they have run out of bullets. And right now, you look at Spain at the second quarter of this year, they're actually net sellers of government bonds, which actually leads right now, right, but actually if you do this, it doesn't solve the underlying problem, it's just buying time. So you notice that the yields has come up a lot of it. Recently, this week, the yields has also come up. Because the debt problem is still there, the countries are not growing. And if you look at Spain bond yields, it's a bit blurred because of the yellow font. If you look at Spain, right, from 3 years to 30 years, it's already over 4%. And you look at 30 years right now, it's already above 7%. If you look at currently 10 years, if I look at from my iPhone, right, it's about 6.6%. So they're going up again, and it's 6.6%, and right now Spain is in recession. It's going to be very tough for them to reduce their debt. But if you contrast this against, say, Germany, which is a different ballgame altogether, their bond yields for 3, 6 months, 2 years, 3 years is negative. What does this mean? It means that, for example, you have a 3-month bill that doesn't give you any coupon. The price of the bond is actually more than 100. That means you buy at 100, if somebody buy 100, when they reach at the end of the 3 months, they have to pay back. The money only give back to 100. So you bought it at 100.03, you get 100. So you're actually losing, you are actually willing to sacrifice part of your capital just to hold on to these bonds. So you can see a lot of contrast. And you look at 30 years is only 2.1%. And you contrast against Singapore. Singapore is a price taker. We do not have any, we doesn't have any controls over our interest rate. We actually follows globally. And you notice that our MAS 10-year bonds, right, is only about 1.4%. The 20-year bonds, that's the maximum we have for the government bonds, is only about 2.1%. It's very, very low. It's very safe, but very, very low. And the next problem that the markets are also worried about is the size of the bailout fund. They call it the ESM, but actually it means the bailout fund. And the problem with that, the Spain and Italy, right, they have debts to servicing, and the budget to servicing about, for Spain is about 140 billion, for Italy is about 180 billion. So if both countries were to ask for a bailout, right, and then most likely they will have to be shut out of the capital markets for, let's say, 1, 2, or 3 years, like just like the Ireland, just like Greece, just like Portugal. 500 billion is not enough. That means 1 year alone is already 320 billion. Then not to mention that you need additional financing from, Greece probably will not meet their bailout terms, probably need more financing. Portugal is still out of the capital markets, and so is Ireland. So this is one thing that markets is very worried about. And the solution that Draghi has said is that they probably might want to have a bond buying program, which is right now, if you look at the Fed right now, Fed has about, out of that 3 trillion, right, they have about 1.4 trillion, which is 1,400 billion of government bonds. And you look at ECB only have about 200 billion. So ECB has actually a lot of room to play. And market is really expecting that, especially next Thursday. Next Thursday is the ECB meeting. And they are hoping that the ECB will come up with some plan on how do they buy back the bonds. And right now you notice that Draghi was supposed to have a central banks meeting today at the US at Jackson Hole, but he probably have to come up with a solution or some sort of plan by this Thursday. If not, the markets might disappoint. And not just that, I think markets also are expecting, the Fed to have some sort of QE3. And this is what you might want to hear for tonight's news, where Bernanke is going to talk about. We will have a speech this tonight at Jackson Hole. So the last time he talked at Jackson Hole was 2010, and that's where he announced or gave some hints about QE2. But from the look at it, it doesn't seem so, given that the US market is actually, US economy is doing quite well. So markets is actually, our house view is that we're thinking that they might want to save the bullets from the next few months, probably with the fiscal cliff. Where fiscal cliff is something that if the parties do not do anything, that means the Republicans or the Democrats do not have come to the consensus, then likelihood is that the next year they will have automatic spending cuts, as well as they will remove the payroll tax cuts that was done during the Bush era. And that, the problem is quite severe, because if, let's say, this thing were to take effect next year, the US Congressional Budget Office, they were saying that they might actually cut the GDP growth by minus 0.5. But of course, the markets are expecting after the US election that both parties will come up to consensus to delay this. But there might be a possibility that the Fed might actually use this bullet, right, to wait for until maybe in the later part of the year. And also, of course, markets also expecting China to prop up the economy, because there's a leadership transition, especially in October. Right now, the 1 year borrowing policy rate is about 6%. There's a lot of room to cut. And the required reserve ratio right now is about 20%. So there are actually rooms to cut. Actually, our house view thinks that China will probably cut rates for another 25 basis points in the next few months. And so our house view is that we think that the markets will be a sideways, it will be like a yo-yo environment. So it will be a very muddle-through environment. So we think that there's a 70% chance that this will happen. Of course, there's a 10% chance that you will have a strong growth, but it seems unlikely. And there's also a 20% chance that you will have a global recession. And if you look at our forecast for this year, we think that US will probably grow about 2% this year. We've already seen that Europe this quarter was a flat. The first quarter was minus 0.2. So we're expecting Eurozone as a whole, the 17 countries, to have a recession of about minus 0.5, 0.8 GDP growth. So you look at China, we still think they will grow, even though it's not a hard landing, it's still growing, even then, 8.1%. We think that UK will be having a recession. In fact, UK is already having a technical recession, 2 quarters of negative GDP growth. Singapore, we think that we get 2.8%. Government says about 1.5 to 2.5%. And India and Indonesia about 6%. So overall GDP growth is still growing about at a small pace, about 2.6%. So what is our strategy, which is the very VVIP, which we use in making investment decisions and helping our clients to construct a portfolio? So this is like a thing that we have in mind when we construct the portfolio. So we look at the right-hand corner, the volatility. We try to prepare for clients for volatility, given the market environment is so volatile nowadays. So we're trying to have a balanced portfolio. So we're trying to have balance between equity and bonds, and sometimes if we can, you become hedge funds, commodity funds to diversify your portfolio. And also to do some dollar cost averaging to reduce the market volatility, to help you to reduce your market timing. And also we don't forget about inflation. And currently the best tools, the best assets for inflation is currently gold and equities. And we're also not forgetting to get ourselves being paid. So amid this environment, we will favor bonds, bond funds, or equities. And at the same time, earning passive income. And last but not least, we also always search for value. Always try to do something, especially buying on dips when things are getting cheap. So we look for opportunities in global equities, high-yield bonds, or Asian local currency debt. And what are the investment opportunities within the VVIP framework? This is our summary of our house views. Basically, we are underweight in cash. We are actually underweight in government bonds, basically the G3 countries like the US, Europe, and Japan. We are actually overweight, and we like the high yield space. In terms of the last 12 months, the next 12 months, we like the global equities. We are overweight on equities. We are overweight on commodities in terms of gold and oil, and also neutral on the alternatives. So in terms of cash, I think cash is good, and a lot of people have a lot of cash, but I think in our view, I think having at most 25% is more than sufficient. Cash is good is for liquidity purpose. But the problem with cash is that you lose your purchasing power. And you notice since December 2010, our inflation rate has always been above 4%. And recently it's just dropped to 4%. But before that it was like 5.3%. And nowadays, even if I take a taxi, it's not so cheap like compared to a few years ago. Housing prices is very high, car prices, but food inflation is about 2.3% officially, but I think it could be more. And actually holding too much cash, we actually have a negative real rate of return. And the problem with holding too much government bonds is the yield is just too low. And you really see insurance companies, pension funds actually getting out of government bonds because the yield pickup is very, very low right now. Imagine US right now is already about 1.65%. You look at UK is only 1.5%. Of course, Singapore is only 1.4% for the 10 years. So that's why we are underweight. But however, we are overweight on investment grade, overweight on corporate bonds, especially the high yield space. If you look at the yield pickup for the high yield space, it's at least 5 to 6% over the government bonds. That's a very good, decent pickup. And one thing about the corporate bonds is that, especially the high yield space, is that default rates actually come down relative to history. So if you look at the Moody's current default rate for the global high yields, is about 2.8%. But you compare this to historical, it's about 4.8%. And the thing about it is that the last few months, there's a run-up in bond prices, if you notice. And a lot of people are searching for you because of the flush of money, because of by the central banks. People are really searching for you. Give you an example. Recently, we have this 15-year NTUC corporate bond, right? It's 3.65%. The size is 600 million. You know how many times it was oversubscribed? It was more than 10 times oversubscribed. 6 billion. More than 6 billion actually applied for this bond, and only 600 million got it. And not too long ago, there's also another US dollar bond, just to give you an example. There's this Indian Overseas Bank, US dollar, 5.5 years. Size is about 500 million. And this is 69% owned by the Indian government. And it's also oversubscribed by more than 10 times. It's more than 5 billion. So if you look at the recent issues, right, most of them, all of them are, decent quality, all of them are oversubscribed. It so shows that how much money is out there looking for yields. And actually, it's also a good thing to add in bonds or bond funds in your portfolio, especially the last few years. You look at 2010 till now, right? It has been always a roller coaster ride. In fact, you look at the start of 2010 till now, right? You notice that the market is really moving sideways. And actually, you are better off if you actually add on bonds into your portfolio. So if you, let's say you add on, let's say 60% equities, 40% bonds, and then you add on and maybe you diversify more. You put 50% equities, 40% bonds, and then 10% gold. You find that even though you get the return about 5%, your volatility actually comes down quite a lot. And it actually makes sense for those people who cannot sleep well at night, especially when your stocks do move up. So actually, this adding another asset class like bond funds actually helps to reduce your volatility and help you diversify your portfolio. And in fact, high yield bonds actually give you quite equity-like returns. I forgot to mention that actually high yield bonds this year alone are already up 10%. And definitely, if you draw a graph, right, it's definitely less volatile. So high yield bonds do give you some sort of equity-like returns, but with about half the volatility. And one thing that we always not forget is that equities is still a good form of hedging against inflation. And you will compare now the valuations, right, like the price to earnings, price to book, right? Generally speaking, they're actually trading at a discount relative to history. So if you look at, let's say, let's take a 5 years daily price to book for the MSCI All World, and I compare it against now. Now is about 1.7. Actually, right now, this price to book 1.7 is actually below the median price to book, which is about 1.79. If you look at, say, the Asia ex Japan, for the last 5 years, daily price to book, currently is about 1.51. And your median, which is medium price to book, was about 1.85. So relative to history, actually they are trading at a very good rate. And if you look at dividends, right now bond yields has come so low. Actually, it makes sense if you look at the equity dividend yield. It's actually much more than the bond dividend yield. Say, for example, the SDI. The SDI dividend yield is about 3%. You compare this against our 10-year government bonds, 1.4%. If you compare the German stock market, the DAX index, the dividend yield on average is about 3.7%. Versus their bond is about 1.35%. You compare this against the UK stock index, the FTSE 100, It's about 4.1% dividend yield compared to their bond yields, 10-year bond yields about 1.5. And we need this mother through sideways markets. Actually, it makes sense to hold defensive high-yield dividend yields. In fact, dividend growth has been keeping pace or actually outpace inflation rate. So you can easily find dividends like 5 to 6% dividend rate, which probably makes sense to hold. And that's why we favor in a sideways market, right, where your capital appreciation is not much limited. Probably while waiting for the markets to dip, right, you might sell getting yourself paid. This is our theme for this mother true environment. And we also like gold. Probably the next speaker will probably talk more. But if you look at gold last year, right, especially when markets drop, right, gold has provided a good, strong hedge for last year, especially in August and late last year. So gold is very useful when the central banks are printing money. So printing money and then making rates low. So a good hedge against inflation. But the problem with gold right now is that gold doesn't pay you any interest. So gold cannot be your core portfolio. At most, you want to buy gold or gold ETFs, it's at most like, in our recommendation, it's more like 10%, 15%. More to diversify your assets. Okay? So in terms of oil, right now oil, the WTI oil is about 95. So we think oil is very well supported, given that now the supply growth has been coming down. The inventories, if you look at the chart, has also come down. And there's a lot of Middle East problems that we hear. So gold is actually a good hedge. Actually gold, if you buy, it's very good that gold dropped like 79, 78, it's a very good time to take. So we think gold is a long-term, will be very well supported. So in terms of FX, right, I think probably it's a good time for you to go to Europe for holiday. So given that the start of the year, Euro versus Sing is about 1.69. So it ever dropped to about 1.52, 1.52. Currently it's about 1.57. And markets are very short Euro, very short. A lot of people are very short. The problem with Euro is that the Europe debt problem is a long-standing problem. It will not be solved within a year or two. The problem is that there's a debate between the northern countries and the southern countries. The northern countries doesn't want to bail out the southern countries because they are afraid that the southern countries will continue to spend, which is the moral hazard problem. So they will make sure that anything that if they want the ECB to print money, they will probably need the southern countries to make sure that they follow the austerity plans. So there will be a lot of ding-dong that you see the next few years. And it probably be like one step forward, two step backward, or one step forward and then one step backward. So, and it will take a while for the Eurozone to have a fiscal union, banking union. It will take a long while. Basically, there are so many 17 different countries with different interests. It will definitely take quite some time before they become like sort of like United States or Europe. And one of our favorite currency is of course Aussie dollar. So, and we think that Aussie dollar will be quite well supported. The next support price, if you look at compared to US dollar right now, currently Aussie to US is about 1.03. So we think the support will probably be 1.026. So as long as China rebound, and if there's a lot of central bank easing, I think Aussie will remain very well supported. Currently, I think Aussie versus Sing is about 1.28 to 1.29. And so to summarize, basically our house view is that we think that the markets will still be a yo-yo environment. And Europe will still be the main downside risk. And please don't forget about this VVIP framework. So it's our view of our way to construct portfolio. So it's about seeking value, prepare for volatility, guard against inflation, and getting yourself paid. So we think the next 12 months is actually, we like the high yield bonds. You can actually go to high yield, you can actually buy a bond fund that is high yield bond fund. We like the high dividend equities, and we are also focusing on getting paid and getting passive income amid the sideways market. And last but not least, this is my main takeaway for you. Please to remember about this takeaway, especially the 5 Prints. Okay, thank you.
Thank you, Wilson. Okay, I think the key question is that a lot of people come to me and ask questions, and I think you'll ask the best person to ask those set of questions. Anyone? Can we open the floor to questions? I think it's a very good presentation there, good overview. I think maybe I'll start with one question. Is it a good time to buy gold? Maybe you should wait for the next speaker, but maybe you get your opinion as an advisor.
Okay, gold, if you look at it in the long, it depends on your time horizon, right? If you buy gold for the long 3 to 4 years around horizon, that is okay, because currently gold is about 1660 or 1655, between around there. I haven't checked my iPhone. So 1 month ago, when gold was actually below 1,600 versus the US dollar, so it was below 1,600. I actually asking my clients to buy gold. So they can either buy the gold ETFs or buy the gold currency. They call it XAU. So we think that at that time the support for gold is like 1540. And every time the gold price dropped to around that price, it was rebounded. There's a lot of strong gold support there because a lot of central banks are buying. Russia is buying. You read the news. Philippines is buying. Because basically the central banks want to diversify away their reserves, especially the US, Europe reserve. They want to have a different, and gold supply is very limited. And there's a lot of demand from India, from China for the jewelry and all that. So our house view for gold, if you look at it, is about 2,100 in 2014. So it really depends on your time frame. If you want to have a trading mentality, and then maybe you want to wait. But if you think that the central banks are going to walk the talk, that means they're going to cut rates, the ECB going to cut rates, they're going to have QE3, then gold prices will probably go up. And actually our house view for gold for this year is about 1,750 and 1,800 in the first quarter of this year. Of course, if you have a long-term horizon, then at this time of gold is okay, which is about 1,650. So it's really depend on the time frame. That was my basic answer. Does that answer your question?
I think it answers a lot of people's questions as well. If you were not answering, so yes, question please.
Maybe I just since you're mentioning about the bond for how you go on with profit, what do you think about the similar to bond like perpetual securities that they have been issuing previously? Is that a good way of investment for yield?
Okay, perpetuals, right? Actually, I own some perpetuals myself. And the reason why, actually perpetual has been around for a few years, especially for those higher net worth clients. Before that, you have your DBS 4.7, you have a Maybank 6%, and those bonds can be quite expensive because if you buy the institutional class, it's about 250,000 for Singapore. It's 250,000, and at that time, even for this kind of bonds like DBS, Maybank, the covenants is actually not as strong as right now, which sometimes is non-cumulative, and then the core date is like very long, 2018, 2020. And more recently, because of the low interest rate environments, a lot of companies are issuing perpetuals, basically because perpetual is considered like equity. So, and if you add in that, right, your equity debt ratios, your valuation ratios actually go down because it's regarded as equity rather than debt for a certain period of time. And I think the why people are very concerned is because you have this Genting perpetuals, and Genting perpetuals you actually issue a lot, actually more than 3 billion. And I think MAS were worried, and people thought that Genting was giving you about 5.125%, which is very good yield. And actually, I bought it at the stock market as a retail tranche itself. But if you look at it, when you buy perpetuals, right, or bonds, right, first thing you need to ask yourself is whether you Are you comfortable with the company? Are you comfortable with Genting? Are you comfortable with GLP? Are you comfortable with DPS? As long as you are comfortable with the company and you look at the ratios, you look at Genting. Genting, if you look at it, the EBIT to interest is 17 times. And every time when they receive collect, it's not receivable, it's money. So the question of not being able to pay your dividends is not a problem. It's really not a problem. But of course, Genting is like a casino, and recently there were a lot of bad press and actually affected. But you ask yourself, bonds is quite a simple game, Bonds, as long as you think that the bond will not fall, be belly up, as long as the company is able to pay you the dividend, right, or the coupon, right, it's okay. So I think it also depends on the risk appetite, because bonds has a longer maturity. The call date for, say, Genting is about 2017. So obviously, if let's say interest rates do go up, of course this perp will actually move, will be much more volatile. So it really depends on the client. So if the client, some clients doesn't want to have a long perpetual, so they want like a fixed tenor, like 3 to 5 years. But sometimes fixed tenor doesn't give you good yields. If recently you notice the UOB bond, it's only give you like 3.1%, 3.15%. Well, of course, the perpetual give you much higher. But in terms of seniority, they are much lower. But back to the basic question, first thing, you must be comfortable with the company and make sure that the company is able to pay the dividend. As long as you're able to hold, I don't think there's a problem.
I hope
does that answer your question?
Sir? And also just sideline in terms of itself, we just actually do have an investment handbook that actually talks about the different types of bonds inside there, and actually even for perpetuals, there is a possibility that actually there is a deferred payment. They don't actually have to pay out the coupon rate. So this is something investors must take note of. It's unlike a normal bond, you can pay your coupon rate, they can actually defer the coupon payment. So these are something that we always like to highlight to investors. Take note, understand the product before you actually invest in them. Questions, ladies and gentlemen?
Well, that's something that I don't really study. But maybe I can give you my 2 cents worth. So I think Middle East, not just the oil prices, I think you realize that Middle East also have this called Arab Spring, where there's some uprising against the central government. So, but I would say oil equities, if I would just lump Middle East as, say, the oil equities, basically, oil equities is also a function of the global growth, which is like your commodity equities. So, in order for your commodity equities to go up, right, there must be a strong growth, like what you see right now. In fact, if you look at the last few years, right, commodity equities has did very badly. I think if you buy some commodity funds for the last few years, you're probably down, you buy in 2010, you're probably down like 20-30%. So if you want to buy Middle East, which is a very good proxy to commodity equities, I would probably not buy a lot. I would buy like 5 to 10%. The stock would not be my core portfolio, seriously, because commodity is not meant to be a core portfolio. It's meant to take advantage, especially if you're in a rising market, and to diversify your portfolio. And the beta is definitely much higher than 1. So right now, there's no catalyst for oil to go up. Oil go up higher is just because of the supply shocks and also the Middle East tension. But you look at growth, hardly any growth right now. You look at the PMI for the world, which is the Purchasing Manager Index, it's below 50. China is below 50. Singapore PMI is also below 50. The global PMI is also below. The only one that is still above 50 is like the US economy. Of course, the Eurozone is below 50. 50 means expansion. Above 50 means expansion. Below 50 is contraction. So you can see global growth is very benign right now. Like what I mentioned in the slide, right? The global growth is overall is only about 2.6%. So unless you see a catalyst, unless you are expecting the central banks, the government to walk the talk, then you might want to position yourself. Because currently, actually, to be honest, the commodity equities, right, actually are quite low right now. Given that they have dropped like 25, 30%, at some stage, some drop about 40%. So if you want to pun, you can pun a bit, but not too much. That will be my answer to your question.
So there's a question here that was going to be answered. You want to start?
I think it's a similar question. I mean, just now you were saying that because of inflation, so oil and gold is a good catch for inflation.
Yes.
So what's the best investment in terms of because the closest to buy invest in oil-related equities or?
Actually, there's a USO oil fund. I don't know if you have, there's an ETF on this, but it's in US dollar. So that one, you can actually buy it if you go to the internet. For gold, I think you can do several ways. You can buy gold equities. Gold equity is faster, but then the more volatile. For the next one, you will buy gold ETFs. Or if you want, you buy the gold currency or buy the physical gold. So normally, it depends on the volatility. If the customer doesn't want to take too much volatility, just want to have a pure play, you buy the gold or the gold ETF. But if you want to have an extra push, especially if you think gold prices will go up, you buy gold equities. Gold equities tend to move up much faster, but vice versa.
Last question. Sir?
Okay.
In your view, do you think euro will break up? If it breaks up, what will be the impact on the equities?
If it's break up, I don't think you can use the euro currency anymore. but I don't think they will break up. I think they put too much. The probability of breakup is very, very slim. The only thing that could break up is that Greece might leave the eurozone. That is the risk that people are expecting because Greece has not been fulfilling their bailout conditions. But given the time, the effort, in fact, talk about this Europe integration, it's been talked about many years already. Ever since the World War II, they have been talking about this. And there's actually an advantage of having a common euro for the Europeans, in fact, because they can actually easily travel between countries. Cross-border doesn't mean a passport. They can use a common currency. It actually helps Germany a lot. In fact, the main sponsor for the Eurozone is Germany, but the main benefit actually gives to Germany. Because Germany, because of Europe, right, Germany has a much lower currency. If they go back to their old currency, they probably have to, the currency will probably have to rise. And this will not be good for their economy. Their BMW, their Merc will be very expensive right now. And they are more export-oriented than the other European nations. So I think there's a lot of vested interest there. Until you see this happening, which I don't see, personally I don't see it happening in the next 5 years or 10 years. So if you look at Merkel actually visited China, and China, Wen Jiabao was saying that he's more confident right now because I don't think there's a lot of interest right now, a lot of integration right now. I don't think they will just give up so easily.
Last question.
Actually, Latin America, if you look at Russia and Brazil, are very commodity linked. You know, this like Russia, if you look at it, it's oil play. If you look at Brazil, it's also very commodity. The main stocks in the Brazil Stock Exchange are all the commodity players. So right now, we are very cautious on Russia and Brazil, for example, because given that the growth is not existent. So if there's any sell down in ever drop in the growth rate, then this Russia and Latin America could suffer a bit. But of course, in terms of longer term framework, is good. Like Russia is still relatively underdeveloped. There's a lot of opening there, and you look at Latin America, it's also Latin America. But look at Latin America in terms of valuations. Actually, I didn't see, actually it's quite pricey at the moment. It's actually above book. So our house view is actually more neutral than not. So if you want to go in, maybe you want to wait for dips. If there are dips, is to go in. And maybe you want to go into a fund if you don't have any specific stocks in mind. Yeah.